If you're looking to buy a small business, and as part of that, you're going to need to raise some capital from investors, and you want to be able to show the investors a projected return, maybe an internal rate of return on their investment over a period of time. I'm going to show you how to do that in this video using our acquisition financial projection template. I'm going to put a link in the description of the video below to this template so you can go grab it and fill it out for your own acquisition, and then use it to model out what investor returns might look like. And so this particular tab that I'm going to be showing you is kind of a tab that an investor could play around with the assumptions and then kind of see what their potential return might look like. So with that, I'm going to go ahead and dive into how the template works. So I'm on the input distributions tab here, and this is really kind of after you have done everything to create the set of projections. I'll run through real quick on the input tabs. There's a bunch of data that you're going to need to put in to fill out these blue assumption cells, things like the purchase date, the purchase price, the opening balance sheet, how you're going to finance it with debt, equity, SBA loans, seller notes, equity investment that's used for the acquisition. So there's a bunch of assumptions here, right? You're also going to need assumptions on revenue projections. And so what we allow you to do is put in the seller's historical financials, and then you can put in assumptions around growth. So how you take the historicals, use that as a baseline, and then apply certain growth rates. So maybe in the first year, we're gonna have a big jump in growth. We're gonna increase revenue by 20%, and then after that, it's gonna flatten out to 5% annual growth rate, for example. And then on the expense side, we do a similar approach. You're going to put in the seller's expenses and apply some either increases or decreases, or add new expenses that you think you'll be adding, and so on. So once you do all that, you're going to be able to create a set of 5-year projections. You're going to get a 5-year income statement, 5-year cash flow summary, 5-year balance sheet here, and then the income statement, cash flow statement, and balance sheet all broken down by month. So this is what you would need if you're going to apply for an SBA loan. This template would be a perfect fit for that. But as part of that, you might also want to raise some capital from investors. And the investors are going to ask, well, what's my potential return on this based on, they're going to realize it's a set of assumptions, but we want to give them the structure to be able to play around with assumptions and see what their returns could look like. So what this tab, this input distributions tab, is doing is we're just taking your 5-year cash flow projections essentially, and then we're applying a percentage of cash, free cash flow that's going to be saved by the company instead of distributed to investors. And so we're saying of the cash that's available for distributions, we're going to keep 50% of that in the company, and that leaves us with this remaining amount, this estimated distribution amount that's available for distributions each year. So that's kind of distributions along the way, but then we also have assumptions around selling the business. So let's say we're going to sell the business in year 5. In year 5, our EBITDA in that year is $216,000 based on our projections here. We think we'll be able to sell this at a 4.25 multiple of earnings. Of course, your multiple is going to vary depending on your industry and growth rate and all those sorts of things, right? But in this example, we're saying 4.25, giving us gross sale proceeds of $920,000. At the end of year 5, we'll still have $673,000 worth of debt we're going to have to pay off, netting sale proceeds of $246,000 here from the sale. Now, let's say the initial investment that you brought in an investor that put in $100,000, let's say, and maybe for that you gave them 30% of the business. So then what we do in this estimated investor share of distributions, I multiplied total distributions times 0.3 each year. So assuming that the investor is getting 30% of those distributions each year, including 30% of the distributions from the sale. So you can see the total distributions here in year 5 is much higher. It's just $353,000. That's because it is including the proceeds from the sale of the business here as well, less what you had to pay off on the loan. So all of that gives you your estimated investor share of distributions. And what we can see then is, okay, we had a $100,000 investment. Here's our distributions. And then here are our investor return calculations. So a simple ROI. And then you can see that internal rate of return calculation here, 17.35% in this example. So if you wanted to then change what the earnings multiple might be, if you wanted to play around with different multiples and see how that impacts return, let's say instead of a 4.25 multiple, it's a 4 multiple, you can see that brings the IRR for the investor down to 13.51%. So anyway, you're able to play around with these assumptions. Hope that has been helpful. If you have any questions on the template, please don't hesitate to reach out at support@projectionhub.com, and we'd be happy to help. Thanks.